Everything you know about money is wrong. Not slightly wrong. Not wrong in the way that most financial advice is wrong. Outdated, oversimplified, or missing a few key details. Wrong at the foundational level. Wrong in the way that a map is wrong when it shows you a road that was never built. The information most people were given about money, how it works, what it is, where it comes from, and how to get more of it, was never designed to make them wealthy. It was designed to make them functional, productive, compliant. And the gap between those two outcomes, between a life of functionality and a life of genuine financial freedom, is not a gap of effort or intelligence or luck. It is a gap of information. And that gap was not created by accident. The first thing most people were never told about money is what money actually is. This sounds like a simple question. It is not. Money is not wealth. Money is not value. Money is not even a store of value in any permanent sense. Money is an agreement, a collective fiction that works as long as enough people believe in it, and as long as the institution that issues it maintains the conditions that make that belief rational. The paper in your wallet has no intrinsic value. The number in your bank account is a ledger entry, a record of a claim you hold against an institution that is itself holding claims against other institutions. The entire architecture of modern money is a layered system of promises, each one dependent on the promise beneath it. Most people were never shown this. They were taught to earn money, spend money, and save money, but never to understand what money fundamentally is. And you cannot navigate a system you do not understand. The second thing most people were never told is where money comes from. The common assumption, and it is an assumption that most people carry through their entire lives without ever examining, is that money is created by governments, printed by central banks,
Let's review
and
the income
distributed through the
verification on this
economy
form.
via wages.
Yes, I've
and
highlighted the
spending.
relevant sections
That is
here.
partially true
Good.
and almost
And the collateral
entirely
details
misleading.
match?
The
They do.
majority of money in circulation in every modern economy is not created by governments or central banks. It is created by commercial banks every time they make a loan. When a bank approves a mortgage for $300,000, it does not take $300,000 from its reserves and hand it to the borrower. It creates $300,000 of new money by making a ledger entry, crediting the borrower's account with a number that did not exist 60 seconds earlier. The borrower then pays interest on money that was created at the moment of the loan. This is not a conspiracy theory. It is the documented, publicly available operational reality of fractional reserve banking, confirmed by the Bank of England in a 2014 paper that stated explicitly that the majority of money in the modern economy is created by commercial banks making loans. Most people were never taught this. And the reason it matters is profound, because if you understand that money is created as debt, you begin to understand why debt is so central to the modern economy, why inflation is a structural feature rather than an occasional problem, and why the people who control the creation of money hold a form of power that no amount of individual wealth accumulation can fully escape. Before we go further, drop a comment and tell us where you are watching from. And if this is the kind of content that finally shows you the full picture, hit subscribe. The Empire File exists for one reason: to show you what they never taught you. The third thing most people were never told is how inflation actually works and who it actually serves. Inflation is presented in public discourse as a natural economic phenomenon, something that happens to an economy the way weather happens to a landscape. That framing is not accurate. Inflation is a consequence of specific policy decisions made by specific institutions with specific interests. When a central bank expands the money supply, when it creates new money and injects it into the financial system, the immediate beneficiaries are the institutions and individuals who receive that new money first. They spend it before prices have adjusted to reflect the increased supply. By the time that new money has circulated through the economy and prices have risen to reflect it, the people at the bottom of the distribution chain, the wage earners, the fixed income retirees, the people whose wealth is held in cash savings, have absorbed the full cost of the expansion without receiving any of the benefit. Economists call this the Cantillon effect, named after Richard Cantillon, an 18th century banker and economist who first described the mechanism in a manuscript that was not published until decades after his death. The people closest to the money creation, the banks, the large financial institutions, the asset holders, receive the new money before prices rise. The people furthest from the money creation receive it after prices have already risen. The result is a systematic, structural transfer of purchasing power from the bottom of the economic hierarchy to the top every time the money supply expands. This is not a flaw in the system. For the people who designed the system, it is a feature. The fourth thing most people were never told is the difference between an asset and a liability, and how that distinction, misunderstood or never taught, determines financial outcomes more than any other single factor. An asset is something that puts money into your pocket whether you work or not. A liability is something that takes money out of your pocket whether you work or not. A house you own and rent to a tenant is an asset. A house you live in and pay a mortgage on is a liability dressed in the language of an investment. A car is a liability. A business that generates revenue without requiring your daily presence is an asset. A job, any job, regardless of the salary, is not an asset. It is a mechanism for converting your time into money at a fixed exchange rate set by someone else. The wealthy do not primarily earn income from jobs. They earn income from assets. And the fundamental shift that separates people who build lasting wealth from people who spend their entire lives exchanging time for money is the decision, made deliberately and early, to acquire assets instead of accumulating liabilities. Robert Kiyosaki described this distinction in Rich Dad, Poor Dad in 1997. The book sold over 40 million copies. The concept it describes is still not taught in a single mandatory financial education course in the American public school system. That absence is not an oversight. The fifth thing most people were never told is how the tax system actually functions at different levels of wealth. A person who earns $100,000 a year from a salary pays income tax on that entire amount at the highest applicable marginal rate. A person who earns $100,000 a year from capital gains, from selling assets that have appreciated in value, pays a significantly lower rate. A person who earns $100,000 a year from a rental property can use depreciation deductions to reduce their taxable income to near zero while the property itself appreciates in value. A person who holds assets worth $100 million inside a properly structured trust pays no income tax on those assets because trust assets are not income. The tax code was not written to be neutral. It was written by legislators who were advised by people whose financial interests it serves. Every provision that benefits asset holders over wage earners, every capital gains preference, every depreciation allowance, every trust and estate provision was placed there deliberately by people who understood exactly what they were doing. The wealthy do not avoid taxes by breaking the rules. They avoid taxes by following rules that were written specifically for them. The sixth thing most people were never told is how compound interest works against them before it ever works for them. Compound interest is described in every personal finance book as the eighth wonder of the world, a force so powerful that Einstein supposedly called it the most important mathematical discovery of all time. What those books do not explain with equal enthusiasm is that compound interest is perfectly symmetrical. It works just as powerfully for debt as it does for investment. A credit card balance of $5,000 at 24% annual interest, minimum payments only, takes over 30 years to pay off and costs the borrower more than $20,000 in total. A student loan of $50,000 at 6% interest takes 10 years to pay off under a standard repayment plan and costs the borrower over $16,000 in interest alone. The average American household carries over $90,000 in total debt. The compound interest on that debt, flowing to banks and credit card companies and student loan servicers every month, represents one of the most significant ongoing transfers of wealth from the bottom of the economic hierarchy to the top in the history of modern finance. And it is entirely voluntary, not because the people paying it are foolish, but because they were never taught how the mechanism worked before they signed the documents. The seventh thing most people were never told is how wealth actually transfers between generations, and why the transfer is not primarily financial. The common assumption about inherited wealth is that it consists of money, of accounts and assets passed from parents to children at death. That does happen, but the more consequential inheritance is invisible on any balance sheet. It is the transfer of knowledge, of financial vocabulary, of investment relationships, of legal structures, of the specific understanding of how money systems work that allows the recipient to protect and grow whatever financial assets they receive. A child raised in a wealthy household does not just inherit money. They inherit a complete operating system for navigating the financial world. They know how to speak to a banker. They know how to structure a negotiation. They know which professionals to hire and which questions to ask. They know that debt is a tool and not a trap. They know that taxes are negotiable within a structure and not a fixed obligation. They know that assets appreciate and liabilities depreciate, and that the only question worth asking about any financial decision is which category it falls into. These are not complex concepts. They are learnable by anyone, but they are not taught in schools, not explained in most homes, and not available in the financial products sold to ordinary consumers. They are transmitted quietly, deliberately, from one generation of wealth to the next, and their absence in the households of everyone else is one of the most consequential educational failures in modern society. Now here is the question that matters most. Can this information change outcomes? Can understanding these 7 things, what money really is, where it comes from, how inflation transfers wealth, what assets and liabilities actually are, how the tax system was designed, how compound interest works both ways, and how wealth transfers through knowledge, can understanding all of that actually change a person's financial trajectory? The honest answer, supported by the documented experience of thousands of first-generation wealth builders, is yes, but with a qualification that most financial content skips because it is uncomfortable. Understanding the system is necessary, but not sufficient. The system has structural advantages built into it that favor people who already have capital over people who do not. Those advantages are real, documented, and significant. Understanding them does not make them disappear. What it does is allow a person to navigate around them, to stop fighting the current and start moving with it, to stop exchanging time for money at a fixed rate and start acquiring assets that exchange money for more money, to stop absorbing the cost of inflation and start holding assets that appreciate with or faster than inflation, to stop paying the maximum possible tax rate on every dollar earned and start building the legal structures that reduce that rate. None of this is easy. None of it is fast. But all of it is learnable. All of it is documented. And none of it requires luck, connection, or a family that already knew the rules. The truth about money is not hidden in a vault somewhere. It is in plain sight, in academic papers, in the Bank of England's published operating guides, in the tax code itself, in the financial statements of the wealthiest institutions on earth. It was never hidden. It was simply never shown to most people. And the difference between a person who understands these systems and a person who does not is not a difference of intelligence or effort or moral character. It is a difference of information. You now have that information. The question is what you do with it. Because once you see how the system actually works, once you understand what money is, where it comes from, who it serves, and how it moves, you cannot unsee it. And you will never look at a paycheck, a mortgage, a tax return, or a savings account the same way again. That is not a comfortable place to stand, but it is an honest one. And from an honest understanding of how things work, real decisions become possible. For the first time, the map matches the territory. And with the right map, the road that was always there finally becomes visible.